And good morning. My name is Chelsea Shammy Calder, and I am your session host today. First off, to kick us off today, we're joined by Rocco from SAS, and he's going to be presenting Redefining Risk Analytics through Generative AI, the SAS ALM Advantage. So please join me in welcoming him to the stage.
Thank you, everyone. Good morning, and welcome to this speech. Today we're going to talk about the asset liability management and its role into risk management and why this is important in the context of banks. But let me start with the first question, if I can manage to. Right. Let's start with the question. Let's assume, let's see, what happens if the Federal Reserve decides to increase the interest rates over the next quarter by 3 times? Would your bank be able to sustain that type of interest rate increase? Could that trigger a panic withdrawal from the bank deposits? You may think that this is a far-fetched scenario, maybe not likely at all, but you might be surprised. We'll get back to this in a few minutes, but these are 2 headlines from yesterday. As a result of the tariff discussions, tariff war between the US and all the other countries, there is a sense of potential inflation that may hit the United States or in general the world economy, and this could turn into an increase in interest rates by the Federal Reserve to try to combat inflation. So these type of scenarios are things that every bank are currently looking at, and they're trying to understand what is the impact of these interest rates on their portfolio. But to answer this question, first let's get to the beginnings. How does a bank actually make money? How do they work? Well, at the very, very basics, we have depositors, people like you and me, that have current accounts. And these current accounts we put our money into the banks, and the banks is paying us a little bit of interest rate, maybe 0.1, 0.2% if we're lucky, but this is the cost that the bank has to receive this deposit. Now, with this interest rate, with this deposit, what they will do is they will go and lend this money to borrowers who need to apply for a mortgage, get a loan for a car, or open an equity line of credit, any type of other different any type of products that the bank offers. Usually they charge an interest rate on that, and that interest rate is much higher than what they actually are paying to the depositors. So the difference between the interest rate they're paying and the interest rate that they are receiving, that's what's called net interest margin, right? And this is how, in essence, a bank makes money. Now, what happens if these interest rates are going up? Well, first of all, think of a scenario like in inflation where people have less money at their disposal, so they will start to withdraw more on their account and put less into their deposit account. On the other hand, people may also start looking at banks that can offer higher interest rates. So they may decide to take their money away and go to another bank where they can get higher interest rate in return. What also happens is that the bank now has to find a way to fund their business, and how they do that is by usually acquiring bonds on the market, on the bond market, on the treasury bonds, and these bonds now are going to be more expensive because the interest rate has gone up. Meanwhile, any bonds that the bank already has in their portfolio suddenly dropped in value, and the reason for that is if the interest rates are higher, those bonds they acquired before are now paying a lower interest rate compared to what they would be paying today. So the value of those bonds now has reduced. So if a bank now needs to quickly sell those bonds because they require some cash to pay off some commitments that they have, what happens is that they are forced to sell these bonds at a loss, and that could squeeze their margin, could reduce their overall revenue to the point that it could actually cause a liquidity crash. And we'll talk about this in a little bit. So the role of asset liability management at a bank essentially is to find the right balance between the timing of the cash flow that come into the bank and the cash flow that are going outside. So we got to make sure that when the bank needs to make some payments out, whether because there are expenses coming out, because depositors are requiring their money back, either way, the bank needs to forecast when the timing of these outflows will occur, and make sure that they have enough liquidity to pay out for those commitments. So asset liability management essentially is working on 3 different pillars. The first is about interest rate management. We talked earlier about the interest income that is being generated and the cost of funding of this interest. So this balance between the two generates an interest rate risk that the bank needs to manage to make sure that if the interest rates are going up or down, what is the effect on their portfolio and whether they will still be profitable or what kind of losses they will sustain. The second aspect is about liquidity and funding planning. Essentially, from a liquidity perspective, the bank needs to make sure that they have the cash at the time when the cash is needed. If I have bonds or if my cash is blocked in a long-term type of product and I cannot quickly sell it, now I am forced to go on the market and borrow money to be able to repay my commitments. And that is going to be more expensive. So it could reduce the bank ability to be profitable, or even worse, I could have a liquidity situation where I don't have cash to repay my obligations and the bank could actually go into liquidity crisis. The third aspect is, well, also to manage the liquidity, banks are usually buying or selling bonds on the market, because this is a very liquid, typically it's a very liquid instrument, except when there are cases when this becomes highly liquid and it causes a crash. Again, we'll talk about this probably in a few slides. Third aspect is about capital management. There is the concept of liquidity capital ratio, and also fund transfer pricing. Sorry for that. And this is the process by which a bank looks at how the cost of money is fairly allocated across the multiple line of businesses or across multiple regions, especially for banks that operate in multiple jurisdictions. So with these three pillars in mind, what does it take to actually perform an analysis of analyzing how my portfolio is going to be affected by changes in interest rate or changes in market conditions? There are different types of challenges. At the very basics, what a bank does is first forecast different scenarios. What happens if, how much the interest rate should go up, how much the unemployment could go up, how much the GDP could go down, and any kind of additional like volatility increases or different type of market risk factor that could affect the portfolio. Once we have these scenarios, we now have to run simulations against the portfolio across all of these different scenarios to evaluate the spectrum of all possible results. And then obviously we need to aggregate these results and see what is the net effect across all of these different scenarios. Well, to do this is a very time-consuming exercise. First, because it takes time to actually prepare the data, prepare the scenarios, load them into the system, run the calculation, configure all the parameters that are needed for the calculations. Second is the actual time that it takes to perform the calculations. We're talking about thousands of scenarios and also thousands of Monte Carlo simulations that need to run at the same time to be able to produce a distribution of possible outcomes. Because banks don't look at this in terms of a single run. They look at what is the distribution of all possible losses and then compute nonlinear measures like value at risk, expected shortfall, to understand basically what is their likely loss that they could face. This is a very expensive exercise and it can take multiple hours. Well, sometimes even days. The third piece is once you calculate all of these things, you then also have to aggregate the results, analyze them, and see what is that telling you. And you need to have expertise in the teams to understand how to aggregate these measures in a proper way, how to collect the data. And finally, you always need to have people that are both technical experts as well as business experts. So as you can see, this process of just running one simulation, it can take from days to weeks sometimes to set it up. Now, why is this important? Well, every day that you're not able to quickly assess your risk, you're risking of basically not being always behind the curve. So this creates kind of a blind spot for the management, because by the time they act on whatever they're seeing as a result, that market conditions already changed. So the floor is quickly kind of moving behind their feet. There's also an aspect about opportunity cost. It's not just in essence the fact that I cannot do my calculations fast. There's a real monetary impact, because if I know the conditions in which I could be in, I can quickly go into the market and maybe perform different types of swap or type of change the type of product mix that I have in my portfolio to put myself in a position where I'm more safe, or I can leverage the changing market conditions. And finally is, if I'm always kind of late and behind, and I'm always doing a kind of a post-mortem of what happened, this reduces the confidence that the stakeholders and the regulator has on the bank. And this is a reputational aspect on the bank itself. So just to go back to the first question at the beginning, why is this really important? Silicon Valley Bank 2 years ago went bankrupt and had to be rescued, basically acquired by another bank. And the speed at which this happened was 36 hours. From the moment they start showing the first losses, they first announced a 21 billion loss because they had to sell a large portion of their bond portfolio at a lower price than they expected. So that showed a very large loss. Subsequent to that, a lot of their customers went to the bank and started withdrawing money because they wanted to bring their deposit to other banks with higher interest rates. That triggered a second wave up to $42 billion in withdrawal within 1 day. That caused basically the bank had to stop. They could not get enough cash to pay all those obligations. That's what caused the whole collapse of the bank. So this is a liquidity crisis that happened within 36 hours. That is why it's extremely important to be able to predict these type of scenarios and run multiple simulations in a very short time. So how does SaaS help? Well, first of all, SaaS asset liability management is part of a bigger ecosystem of solutions that we have. We call integrated balance sheet management. We cover everything from data processing to modeling to capital requirement, calculations for ECL, IFRS 9, there's different types of regulations, as well as climate risk. Obviously, there's not the time today to talk about it, but if you're interested, you can always come back to the booth and we can talk about all of these tools. Within specifically the SaaS ALM, the process is essentially made of 4 parts. We have the initial data preparation, where we can collect all the data, perform data quality, and make sure that we have a data repository that keeps track of every single version of your data that you have. This data is then feeding the various calculations. You have a multitude of different type of analysis, multiple type of pricing functions, cash flow generations that basically cover pretty much every type of instrument that you have at a bank, whether it's a vanilla instrument or more exotic ones. And obviously, once the results are generated, we are then aggregating them and providing reports that can quickly help you understand what is the impact on your balance sheet across multiple scenarios. It's not enough to do the calculations. You have to do them fast. How do we do them fast? We have a distributed architecture. Our system is able to elastically scale on the fly, grab additional nodes, perform all the calculations in parallel, and when all the calculation is completed, bring all the results back and shut down the entire system. So it's not only fast, it's also cheaper. And just to give you some idea, we've recently run an analysis. We were able to increase by 100 times the performance of the execution through distributed computing. Also, calculations happen in memory. So again, there's a very little transfer of data between the different nodes in the machines. We're also finally working on a new groundbreaking technology, which is about how do we perform nonlinear aggregations across multiple systems without having to sort the data. This is going to give us probably another 10x, if not another 20x performance boost on these calculations. Finally, let's get to also the productivity part where, okay, we have to have the calculations, we have to be fast, but it would be nice if we were able to configure all of these things in an easier way. As I said at the beginning, sometimes it can take a week to perform all of these type of configurations. So for this reason, we introduced the ALM Copilot, where basically you are able to perform a various type of tasks. The very basic one is you should be able to query data within your system, different types of objects that are available within your ecosystem, perform query and aggregation through natural language processing. The third most important part is actually the ability to configure a run and trigger a run with all the different parameters, meaning also shocking the different scenarios and automatically uploading those scenarios into the system. And finally, also have a summarization of all of these results with commentary from the LLM. So let's jump into the demo. So what you're seeing here is a screen of the list of analysis run. There's a lot of different objects, and on the top right side, you see the ALM Copilot. So essentially through the system, obviously we can ask a couple of different questions. there's also the ability to actually do text-to-speech and speech-to-text. So you don't just have to type, you can also talk directly to the system through your microphone, and it's going to take up your inputs. We can ask, like, how can you help me today? What kind of things you can do, and it's going to guide us through different options that are available. What we want to do is, as the first thing is, well, let's list all types of analysis that we've already performed in the past, so we can see which one of these we can then go and stress and rerun and perform different types of calculations. So what we're seeing here is a list of any runs that was already performed on the system, whether it was we also have template runs, which are basically predefined templates where most of the parameters have been already predefined. What we're going to do is we'll select the IRBB template. So IRBB is basically a regulatory type of calculation that looks at the internal risk there's an internal model for interest rate risk of the banking book. And there's a capital requirement associated with running these type of calculations. So the system is going to basically create a copy of that template, and then we will ask basically what are my options, what type of parameters I can change in this particular analysis. So the system is going to tell me, well, you have to provide a portfolio, you have to provide a set of scenarios, the market risk data, and also the type of reports that you want to generate out of this. We will basically keep, for this particular run, almost everything to be the same, except that we want to actually shock the interest rate, because this is the part that we are more interested in. So we will want to shock the different scenarios. What we can ask the system is, can you tell me what are the options, what type of risk factors that are available in my system right now, so I can then see what type of shocks I will be applying on it. Is it still running? Yes. So this is showing us what we asked actually to look at the US specific interest rate yield, and this is showing us the tenure of the specific risk factors of the yield curve. And well, we could just say I want to add 100 basis points to this particular risk factor or that particular risk factor, or we can just say, why don't you suggest me what are potential scenarios that I could consider given the current macroeconomic conditions. So what this is going to do is going to suggest, in this particular case, a parallel shift of the interest rate curve up by 100 basis points, a shift down, and also an inversion of the interest rate, where we're basically increasing one part and reducing the other part of the interest rate curve. With this particular setup, we'll say, I'm all good, apply these changes, and perform the calculations. So what happens right now is the system takes all of these risk factors, registers them into a piece of technology that is part of our solution, which is called Scenario Manager. So inside the Scenario Manager, so this way we also have an audit and track of all the changes that we've done through all the different types of analysis. Our Scenario Manager right now is showing us the change that was applied. You can see there the value of, let's say, 300. Why is it not 100? Well, because on the IRBB baseline shock is already 200 basis points, so it just added another 100 basis points on top of the baseline 200, which is required for regulatory purpose. So once we run the execution on the left side, you'll see that the new analysis that was created. And what we could do is say, okay, fine, we got the results, we shocked our scenarios. Now I may want to actually get some kind of report, right, or some summarization of the results, and potentially compare it to the base case scenario. How are things changed based on the baseline that I already executed? So this is going to take a little bit of time because it has to basically collect all of the results across different scenarios, put them all together, run the comparative analysis, and generate a fairly comprehensive report, which could then also be converted into a PDF maybe, or into a PowerPoint for your ALCO committee. Imagine that now you are in a bank, in the asset liability committee, and the CRO is asking questions, what could happen if the interest rate goes up or down? You don't have to wait a week or go talk to your analyst and prepare this whole calculation and then come back 2 weeks later with a result. You could potentially do this right there in front of the CRO and start asking more questions. That's the power of it. The more you can do this, the more questions you can ask, the more type of analysis you can do with the system. So here what we're getting is essentially a report of what were the shocks that were applied to the system, what was the type of analysis, and the difference between the base case as well as the different types of shocks. When there's a parallel up, parallel down, what is the difference compared to the baseline? So you get all this summarization directly from the system. But okay, this is all nice. I can generate a report, I can generate a PDF, but what about being able to drill down and analyze a little bit more my data in a graphical way? So we also have a set of reports that will show up in a moment as soon as this one finishes up. But meanwhile, we have different types of report that we look at, and they are about analyzing, first of all, the balance sheet. So in this case, we're looking at, for example, what are the different interest rates for the yield curve across the different tenure. This tab is about the balance sheet forecast, essentially by asset and liabilities, what is the timing of them across different scenarios. The third piece is about net interest income, where we can look at what is the impact on my, essentially on my margin of the interest that of the bank that generates across multiple scenarios. And there was also another type of report, which is about calculating the economic value of equity. Essentially, overall, after asset and liability, what is the impact on my overall equity of the bank and my balance sheet as the interest rate goes up or down. So there's a variety of different reports. For the brevity because of the time that we have, I had to squeeze it into very few screenshots, but happy to look at this and more in details if you guys are interested. I know that we're out of time, but before we close up for this, I just wanted to ask you one more question. Like, what is scarier? Is it raising interest rate or the fact that it takes a week before you can get that answer? Because that could be the difference between a Silicon Valley bank or a bank survival. Thank you for attending, and I'm here to take any questions.